Welcome, I'm Catherine Magana here with Greg Carroll, Rachel Ivanovich, and Steve Wolf, where we're here to give you insights on the markets and planning and tax planning. I'm back from vacation. Here I am. The work didn't go away, but you know what? It's good to be back. Looking at the markets are still in positive territory for the year. The Dow Jones is up, the S&P 500 is up, and even the Russell 2000 is up. And it's come up pretty close to some of the bigger stocks now. So it's been kind of an interesting market.
And the Russell 2000 is a small stock
that is correct.
Index.
Yep. And that one's up almost 11% as of yesterday, which today's August 1st. And some of the most recent news is the Fed came out and they're not changing rates, which is what we expected. But it looks like potentially in September, the next meeting, they're going to have a rate cut, which is something we've been talking about all year long. And I think it's probably time for us to see a rate cut.
Yeah, they were talking about that it's probably time to start doing it. They're going to certainly look at it in September. You can see that the economy is slowing down. And last week we talked a little bit about, is it good news or bad news? Yesterday, the stock market was up a lot because they said that, or they thought that Powell was going to lower rates. Today, the market is down because the economy seems to be slowing down. So, you can't have it both ways.
Yeah, it's funny because, one day it's good, for the market, and the next day the same information is bad. So, I think we're going to get a lot more of that type of information like we talked last week. Coming up to the election, you're going to hear a lot of noise about the election, different candidates, what they're going to do to the markets. But, just to reiterate again, I pulled up a different set of statistics here on election years. The first year of presidential cycles, it's positive every time, except for in 2001, which is right after the dot-com bubble when we were kind of in a pretty deep recession. The markets do really well that first year of the presidential term. So
you also had 9/11 happen that year.
9/11, and so that was an unusual time. So just keep the longer term perspective. Don't listen to all the noise out there. Don't get scared because these markets are doing some crazy things on a day-to-day basis. But long term, things work out.
That is no different than ever before in history. The markets, I think we said this again last week. For those people who want to tune into what we said last week, you can get it online. But basically, we're saying that, markets will go down 10 to 15, even 20% a year, once or twice per year. That's not uncommon, but we all get, out of sorts, so to speak, and worry way too much about what's going to happen in the short term. So yes, the technology stocks got ahead of themselves, and they're pulling back. There's a rotation out of some technology stocks into other stocks. But if you're looking ahead 5 to 10 years, even 3 to 5 years, I think we're just in the beginning stages of the AI boom, and I think tech will continue to do well, but it has to adjust to where their earnings are.
Yeah, and I mean, if everything went sideways from now until the year end, we still have a great year in the market.
This has been a good year.
I mean, small caps, large caps, technology, value, everything's having a great year. So,
but the chances of it going sideways are pretty slim.
That is true.
Yes.
So it's going to do one thing or another. I mean, I still think that we're a little bit overvalued in the tech stocks. Wouldn't surprise me to still go down a little bit more. But if it does, in my opinion anyway, is, you probably should look to maybe add on to your portfolios in that case.
Exactly.
So, and by the way, as I look at this a lot, and probably you guys get tired of hearing this, but the CNN Fear and Greed Index is down to 41 now. It's now firmly in fear territory. I actually like that because it means that some of the euphoria of the stock market is waning, and usually you're going to get better opportunities to buy things because they'll be lower in price. Now, just know that you can go from fear to, horrible fear. I forgot what that's called on their scale, but it's extreme fear, I think. And that can stay there for a while. But generally speaking, when it's in that territory, if you start loading up on good companies, that's probably a great time to do it.
What's interesting about that is, retirement plans, 401ks and the like, when you're contributing every other week or every month, you're buying all the way down. You buy the dips, you buy the high spots, but over the long term, you get a better than average, cost basis. So, the idea is, just don't get emotional. Just look at things. And when it's extreme fear, maybe if you got money on the sidelines, it's a good time to maybe shop a little bit.
Or are you maximizing your contributions? It might be a good time to increase it if you're not.
Exactly.
I think you should check your own emotions too. I mean, if you're really starting to get really scared, the chances are we're in that extreme fear territory, and that's when you ought to be looking to buy, not to sell. I always tell people, would you rather buy your house when it's at 500,000 or when it's at $1 million? Certainly you'd rather have it at 500,000, but for some reason, we have the only industry that I know of that when everything goes on sale, everybody walks out of the store.
So over the last few weeks, we've had a lot of conversations with clients that are buying or selling properties or moving. And so recently, we actually have a client that we're working with, and they need a short-term loan. So one of the things that we're looking at is a pledge asset line, which is also considered a PAL. And what that does is it allows you to basically borrow against your investments, but there are minimums and there's certain levels you can borrow against. And yes, there are some risk involved if you're borrowing and you don't want to take too much because there could be margin calls. But if you need a short-term loan for a few months, it might be something to consider instead of trying to sell off your assets, and there's a lot of gains. And so from a tax perspective of gains and losses, potentially, doing a PAL or a pledge asset line might make sense on the short term or even up to, a year. But more than that, at some point, it doesn't make sense, I think, to have a lot on a line, but just know that there's some other planning and options that we have access to for our clients.
And if people want to know a little bit more about a PAL, you can always contact us. And Catherine has become an expert on this, so she'll be more than happy to answer the questions.
I wanted to tag on to that. When you were just saying that a lot of people are selling their homes and they have large gains, I'm seeing that as well. And one of the planning opportunities that I've been doing a lot of projections for recently are clients who have decided to sell their primary residence. They have large gains on them, and then they're moving into retirement communities. And one of the things that's surprising a lot of them is that there are entry fees that are tax deductible, and these fees are hundreds of thousands of dollars. And so if you plan it correctly, you can use those fees, and as long as you're paying those in the same year that you sold your house, you can use those fees as itemized deduction to medical expense to reduce your capital gains and your taxable income. So I think it's just really important when you're thinking about selling your home, make sure you're talking with your advisors, because there are a lot of planning opportunities out there.
And speaking of selling homes, just in my neighborhood alone, I live in a 55 and over active adult community, and there's probably...
Steve, you're over 55?
Well, I had to lie.
They let them in. Just kidding.
But when I'm walking my dog around the neighborhood, I'm seeing a lot more for sale signs than I've seen in a long time. And I think it's definitely correlated to mortgage rates coming down. Just before this podcast, I looked to see where rates were, and I actually could find some with a couple of points, but in the fives.
Oh, wow.
So 5.6, 5.7.
But you're paying for that. You're buying that down.
You are.
Because the going rate's probably still...
It's around 6, but it's still less. We were at 7.5, even close to 8 for a while. Oh. So I think they're correlated. I really do. I think as interest rates are coming down, more people are saying, well, okay, maybe now's the time that I can sell, because if I rebuy, at least, it won't be 8% mortgages. Right. Or, of course, they'll use the cash to buy something.
So going back to the selling real estate, we have a new client that started working with us, and she recently sold a property and brought some of the money over for us to invest so that she can generate income and have the money to live off of. But one of the things she wasn't 100% clear on was, did she owe any taxes? And so obviously we'd like to look at this before you sell, but coming in after, we were able to work with Rachel and look at, what's the tax consequences. And thankfully for her situation, she was at a good place and there wasn't any taxes. But just know in general, when you're buying and selling properties, really let's look at it from a planning perspective. Let's look at it before, if we can, just to make sure, that we're not missing anything.
You have to look at all angles, and I believe she had been married and lost her husband, but she did still qualify for the full, $500,000 exclusion. So definitely work with an advisor. There are so many different angles where you could reduce that gain on the sale of a primary or a investment property.
Okay, well, that's probably a wrap for this week, and we'll see you guys next week, and have a great week.
Great, thank you.
Bye.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.